Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Back in the studio with Aaron Ricketts. Hey, Aaron.
Hi, John.
Well, we're into the new year.
Yeah.
But there's one thing, regardless of what year we're in, we always know we have something that we can relate to. And it's called taxes.
Oh, yes.
We love relating to taxes, right?
Yes.
Or not exactly.
Well, we look forward to two things. One is spring, right? When we're, into, usually January gives us, February gives us our bad winter weather, right? Or our tough to get around weather. We still might like winter, but it's more difficult for us up here, right, than it is down south. So we look forward to spring, which is nice, and mid-April, is kind of pushing that spring envelope. But what's due on April 15th? Your taxes. And most people, they like to get their taxes done early, right, February. So within a couple weeks, 3 weeks, be a lot of returns being done and people getting their refunds back in 1 month from now. But I always like this time of year. It's kind of strange, but it kind of settles up, right? What we've done the previous year, and then we can plan and do some things for this next year. I want to start out by giving the new contribution limits for 2020 contribution limits for that are set by the IRS for your IRAs, 401ks, your retirement plans in general. So next year, you're going to be able to put in exactly what you could this year, which is $6,000 into an IRA, or $7,000, an extra $1,000 if you're 50 and older anytime in 2020. But also remember, you can put in for 2019 up to the day you file your tax return, or April 15th this year. So keep that in mind. You'll be able to do that. And the limits haven't changed on IRAs. Nothing has changed. The annual contribution limits for 401ks, 403bs, your federal TSPs or thrift savings plans, or your 457 plans for most of them, are increasing $500 in 2020. So the annual limit on contributions will be $19,500 that you can put in there. And if you're 50 and older anytime in 2020, you can contribute $26,000. So you can put in quite a bit more. And we have several clients that do max out their 401ks. Maybe just one a husband or wife in the family, but they'll focus on maxing that out and getting that $26,000 in there, or $25,500, which was what it was in 2019. So keep that in mind and know that that's going to happen. If you're self-employed or you own a small business, you may have a solo 401k, as they call it, or a SEP IRA, SEP IRA. And it's just an IRA, but gives you there's some restrictions and gives you some higher limits. The ceiling on the total solo 401k and SEP IRA has been raised $1,000, and you can now put in $57,000. Now, that's a lot of money, right? You can put in. So these are higher income earners, but it's $57,000 or 25% of your adjusted gross income, whichever is less. So if you make $300,000 in a year, you could contribute the $57,000 because it's more than that, less than that 25%. If you made $200,000 in a year, 25% would be $50,000. So you could only put in $50,000, not the max of $57,000. So that's kind of how that works. Be nice to have that issue, right?
Yeah, right.
Have to decide if you want to put in that kind of money, or if you could afford to. Simple plans. A lot of people have simple plans. These are very common. Retirement accounts, and again, they're just a special type of IRA that is for small businesses that help their employees do some matching. This next year, 2020, I'm sorry, we're there now, $13,500. That's up $500 from 2019. If you're 50 and older, you can put in $16,500. I tell people that have, single business shops where they don't have any employees, or maybe they have a part-time employee that makes, $10,000, $20,000 a year. The simple plan is a really simple way to make contributions higher than those. I pointed out the 6,000 limit or 7,000 limit on your traditional IRA. So I always talk to people when they ask me questions about setting up a plan for their office. How many employees you have. Here's the limits. Where do you think you fall and how much you can contribute? If you don't think you can contribute more than 7,000, and that could be a husband and wife together, so that'd be 14,000. If you don't think you can do that, or do just to that amount, stick with the IRA. But if you think you can do more, then do the simple plan. What's nice about simple plans is you can open those plans up right up to the day of tax filing day. So if you're talking to your financial advisor or your accountant, and you have, say excess income, or you had more income, you have excess money in the bank, it can certainly reduce your taxable income, and it's a great way to save. So keep that in mind. The simple IRA is around $13,500, and then if you're 50 and older, it's $16,500. Your health savings accounts, and you hear me talk in many of the shows that we've done, or I've done over the years, talking about this thing is like the sliced bread of savings. And if you have the opportunity to do a health savings account, I would suggest you think about if it works for you to max this thing out. I know some like the county, Lenawee County, and other employers, they'll put in for your deductible. So if your deductible this year, say, is $2,700, they'll put in $2,000 or $2,500, whatever it might be, or the $2,700. They just fund it for you. Then you use it for your co-pays and your deductibles throughout the year. And then you still have the option, though, to put more money in. And that's what I suggest you look into, depending on your, there's other things. You need to talk to your accountant or talk to a financial advisor. Call me. We'll look at your numbers. But the limits are $3,550 for individuals and $7,100 for couples. And then if you're 55 and older, you can put in an extra $1,000. So if you're a couple, you can put in an $8,100 into your HSA. So especially if you're maxing out all your other plans, you're maxing out your 401k and or IRAs, you could put in up to $8,100 if you're over the age of 55 or 55 and older. What's great about this is it turns into an IRA once you turn 65. And that's my whole point about why not use that as another savings vehicle or savings tool. You can still use it, right, for qualified medical purposes, which they continue to expand over, more and more and more. But I just say to people all the time, that's one thing on my checklist when I meet a new client. Do you have an HSA now, or do you have the opportunity to be in an HSA, health savings account? Because it's great. To me, it's like when the Roth IRA came out, that was the sliced bread of investing. The health savings account is now that new sliced bread of investing. All right, let's talk about some taxes.
Oh,
tax
great.
laws.
Great.
I wanted to go right to a discussion about the Secure Act. And I know my clients are we've had this discussion with them and have been staying up on this. But what the Secure Act is, or was when it was a bill, was to make some changes to the retirement savings part of the act. So it passed, and it will be it's in effect right now. So the Congress passed the Budget Act, the budget funding bill, we should call it, or the government funding bill. and the president signed it. So here we are. Inside that bill was the Secure Act. And so here we are in 2020 with some new rules. Here's the good stuff. Some of it's good. One thing that we're not happy about in our business, but most of it's good. Among some of the items, it requires 401k plans to allow more part-timers to participate. So that's a good thing. Here's a big one. Increases the age for taking required minimum distributions from any of those plans, workplace plans, IRAs, to 72. Right now it's 70 and a half. So interestingly, every year we have, clients that age into that. So we work with them, when to get that money out and how you want to take it. And so some people will have taken it this year and then won't have to take it for another year because they won't be 72 yet. So that's a good thing. Talk to your accountant, talk to me, talk to your financial advisor. If you got questions about that, our company is going to have next week is going to have a company-wide conversation about it to make sure we're all up on this. It's going to also let IRA owners or traditional IRA owners make contributions past 70 and a half. So if you're working, you can make those contributions. Interestingly, let's say you're still working at 75. Remember, 72 is the new required minimum distribution. So you got to take your required minimum distribution, but you can also contribute if you are working, if you have earned income. So you, in essence, can just put it back in. We'll see how that all works, because we do have some that work. Yeah. A typical or typical income is those that sit on boards, sit on executive committees. They might be trustees in their township, so they have $6, $8, $10, $15,000 of income, and they would be able to then contribute if they wanted to, right? If it's in their best interest. So that is kind of the good stuff in a nutshell, just kind of extended things. The one thing we're not too happy about is about inherited IRAs. So an inherited or beneficiary IRA is just what like it sounds. You inherit an IRA. Now, if you're a spouse, you can take that IRA as your own. And most of the time, it's our recommendation that you do that. When you take it as your own, you have no restrictions, or you have the same restrictions as the former owner. So that hasn't changed at all. An inherited or beneficiary IRA, an example would be when your child, let's say you're 85, you pass away, and your child is 60, your child would inherit that IRA. The old rules would require that your child take out that minimum distribution that you were taking all those years, but they can in essence stretch it over their lifetime, and then they could pass it on to their children or your grandchildren if that's how that worked. So the new rules are that all those inherited accounts that start this year, so everything else is grandfathered, all those old inherited IRAs are grandfathered in the old law, but the new ones that start this year have to be cleaned out within 10 years. And there's some exceptions to that, and make sure you're talking to your accountant, to your financial advisor. I know this is a big change for a lot of us, and I've gotten a few emails from some clients that, have already, emailed their congressman complaining that, this is not what we planned for. We planned for years and years to use this as a plan, as a tool, right, to pass along assets so we don't have to pay taxes. But that's how it worked, and that's what the new rules are. So if you got questions about that, since we're at the end of our show, my number is 265-3540.
All right, Aaron. I think it's going to be an interesting tax year, and certainly 2021 is going to be an interesting one too, depending. So
that's right.
All right.
That's Money Talk with Aaron Ricketts, presented by Ricketts, Ricketts & Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.